Welcome to our webinar on investing, pensions and growing your wealth. I'm Simon Lambert of This Is Money, and joining me today I have Charlotte Ransom, founder and CEO of Netwealth, and Jeff Prestridge, Group Wealth and Personal Finance Editor of the Daily Mail and Mail on Sunday. Over the next half an hour or so, we're going to be discussing the things savers and investors need to know, how to protect your wealth and how to keep it growing. But before we do that, first a bit about our guests. Charlotte, welcome. Tell us a bit about yourself and a bit about Netwealth as well.
Yeah, thank you. So I was a banker for 25 years and spent a long time actually at Goldman Sachs, where I was a partner for 10 years. And during that time, I started to get quite a good idea of what was going on within the world of finance, and then in my final few years in personal finance. But it was actually only after leaving the bank and thinking about my new situation of no longer being in full-time work and what to do with my own money, that I started to be more and more aware of the fact that the sort of more traditional services for wealth management were still not incorporating modern technology from everything that I could see. So what we've done with Netwealth, which we launched in 2016, is to keep the best bits of traditional wealth management, which is typically the people, whether they're the people managing your money or the people offering financial planning advice, and at the same time using technology to really give the user a much better experience, much greater transparency and control, and also to be able to keep costs really low.
Thank you. And Jeff, I don't need an introduction. I've been working with you for nearly 2 decades now, but tell our viewers, tell us a bit about yourself and what you do.
Well, I've been a journalist for more than 30 years. I shall never forget my first week as a journalist, Simon, because it ended with the stock market crash of 1987. I nearly lost my job within the first couple of weeks of starting. I then went on to work for the Telegraph and have been with the Mail group since 2000. So it's been well, earlier than that actually. It's been a long journey.
And a few stories along the way.
A few stories. Investing is part of my DNA. I'm a big believer in consumer education. I also see myself as something of a consumer champion. I think it's very important that we have a system that enables people to make good decisions and being given good value for money.
Thank you very much. Right, and without further ado, we shall move on to some of these reader questions. Charlotte, I'll come to you first. A question here: the inflation shock that followed the pandemic has led interest rates to rise faster and to a much higher level than anybody expected. How has this changed the landscape for investors? And what does a future of potentially higher inflation and higher for longer rates mean for people's wealth?
Well, certainly a good question and a reality that we're all living with now. Perhaps just to give a bit of background as to why we are where we are, it's worth remembering that we had a global pandemic in early 2020, and at that stage, global central banks did everything they could to put more liquidity into their economies and to really try to ease financial markets and to try and propel growth further forward. That came on the back of quantitative easing that had really been going on since the global financial crisis, 2007, 2008. So many years of interest rates coming progressively lower. And then all of a sudden, in December 21, if we take the base rate that the Bank of England had set, we were below 1%. And from December 21 to now, we have gone from below 1% to 5.25%. So that in comparison to being below 1% for the previous 15 years. And that gives an idea of why this has all been such a shock to people, because we've actually lived with a very benign investing environment. We've been able to borrow cheaply. Generally, markets have gone up. And for most people, there has been quite an agreeable type of investing backdrop. And suddenly, we're no longer in such an agreeable environment where we've had much higher inflation, as the question said, and higher interest rates. I think where we're at now is the markets are starting to normalize. So having been through that period of very high inflation, that's starting to come off. Our expectation for long run inflation over the next, say, 5 to 10 years is an average of just below 3%. So in fact, when you think about that in the context of historical average inflation at 2, yes, it's gone up to 3, but we're not going to be living with double-digit inflation for years to come, which at one point it felt like we might. So from an investment standpoint, I think now is the time to be thinking about the usual things around time frame and investment goals and so on, in the knowledge that probably markets from a fixed income standpoint are going to pay you more than they were, given the fact that interest rates will remain higher than they have been, with inflation somewhat tempered over the medium term, and also equity markets now working out what that risk premium they need to pay in order to have people want to invest in equities. And we'll probably get onto that, I think, a little bit later.
Jeff, I mean, have you been surprised by how fast rates rose and how high they've gone? Does it change what you might have thought the future looked like for investing?
I don't think I could have kind of guessed back in 2020 that would be where we are today. I never thought that rates would rise so fast. I never thought that inflation would soar to double figures and then come down to just below 7%. I think really that the world has changed for UK consumers, I think more than it has done for UK investors. There's no doubt that we face great challenges, be it more taxes to pay, in terms of an employment market that we're unsure about, an economy that is giving very little growth. So I think really the future for us as UK households is a far more difficult one than I think it is from an investment point of view, because as Charlotte has already said, the case for investing in stock markets, I think it hasn't been weakened by what we've experienced over the last couple of years. I still think that over the long term, to invest in equities has to be the way forward. So, you know, my view is keep investing. What might change is that people's propensity to invest is less than it was, you know, in the years when interest rates were low. Because of the fact that they won't have as much disposable income available to put maybe into an ISA or into their pension.
And that reflects the next question we've got from a reader, actually, which is something I admit I get asked a lot at the moment. And we get asked is, you know, why is it worth investing when I can get 6% from a cash savings account? What would be your answer to someone who asked you that?
Well, not everybody, I think, can get hold of 6% from a cash account, Simon. You know, many UK banks, for example, are paying much less than that to good, honest savers. But of course, the attractiveness of cash has increased in the last couple of years. You know, there was a time back at the end of 2021 when people were getting 0.01% of interest on their savings. So that has changed. But bear in mind that, you know, the 6% figure that you quote is against a backdrop of inflation of 6.7%. So cash in absolute terms looks more attractive than it has done for a long, long time. But in real terms, after we've taken inflation into account, it's not as compelling. Of course, you know, when we invest for the future, when we put our household portfolio together, what you need is cash, ready cash that's available, and you also need money that is in kind of longer term investment baskets. So I don't think really it's a case of one or the other. They are essential components of a good household investment portfolio.
And Charlotte, what would be your response to a Netwealth client who said, well, you know what, thanks very much, but I'll put my money in a savings account right now and I'll keep it there?
I think this has actually been very interesting because, as Jeff was saying, we haven't previously had this choice and it sounds very attractive. Something which has really astonished me is the terms that are on the higher rates that are dangled in front of people. So there was actually an article this weekend talking about the fact that some quite well-known names have had people able to lock into a 1-year rate a year ago, which in the event they don't switch back out of it, they're put into a maturity account, which pays anywhere from at best 2.25%, at worst 0.1%. And that is what is absolutely unacceptable, that people are being taken advantage of by thinking that they're not now locking in this very attractive rate. So, for example, what we've done at Netwealth to help counter the understandable interest in trying to know what you're getting in the short term, and a recognition that this could be money you can access easily, is our risk level 1 is actually money market funds, so that it fluctuates with the market. Right now it's, I can't remember, 5.75%, and it'll go up and it will go down according to very short dated bonds. But there isn't a maturity. And I think, as Jeff has said, it makes sense to have easy, accessible money as part of your overall setup. And of course, you want that to be at as high a rate as possible, but read the terms.
I also think, with regards to cash, Simon, is that there are allowances. There's your ISA allowance that you can use to shelter any interest that you get from cash, from tax. We do have savings allowances, annual savings allowances, which for a basic rate taxpayer are £1,000 a year. But of course, as interest rates go up, the amount of cash that you can have that is protected from the Chancellor taking a great big slug of it, 20% of it, is diminishing. So you need to kind of play clever with your cash. Don't just put it in with a high street bank and think that they're going to look after your best interests, because they're not going to look after your best interests. They're looking after their best interests.
And that is, as you say, the tax issue is certainly something that's coming up a lot with our readers at the moment, is that, £1,000 personal savings allowance of interest seemed pretty good when rates were 0.75% or 1%. The rate didn't seem very good, but you could get a lot of it, tax-free. But now rates are at, potentially 5% if you move your money and you don't just sit in your big bank's terrible account. Mm-hmm. People are starting to get taxed, but also we've got a freeze on tax thresholds that's pulling more people into higher rate tax, so they only get £500, and we've had the additional rate tax band lowered to £125,000, and you get zero then. It's quite important, that tax element, isn't it, for people when they are investing, Charlotte, to get those bits right, and so that you don't find your very hard-won returns being eaten into due to some simple mistake that you've made.
Definitely. I mean, I think that the thing we ought to all remember is, what are the tax advantages that are on offer to everybody? And Jeff's already mentioned pensions and ISAs are the two best tax wrappers available to everyone here. And I'm often quite interested that, for example, within a family, you might find one adult has topped up their pensions, done their ISAs, but they might not have thought about both adults doing it, or doing it every year, year in, year out, and making sure that, for example, with ISAs, if you don't use it, you lose it. So it's very important that you are able to keep filling it up to the extent possible. I think the other thing which we see is, as people get to retirement and they're thinking about retirement planning, is in what order you take money out of these wrappers. So it's both filling them up and then really thinking carefully about how you withdraw. Because, for example, at the moment, a pension falls outside of your estate from an inheritance tax planning point of view, and there's obviously chit-chat about whether inheritance tax will go, but let's assume it stays. And therefore, it's a very relevant part of your overall estate planning as you age and you think about the next generation.
I think, I do think, with regards to the tax wrappers, Charlotte, we mustn't forget our children and our grandchildren, and the fact that there are things called junior ISAs that we can take advantage of and put money aside for our children, and also the use of a pension to start a savings plan, an investment plan for a child from a very young age.
Absolutely.
And that little bit, even from a very young age, has a very long time to compound, doesn't it? And that can make the
sooner you start, the better.
A massive difference. Well, on to a question from a reader, which is this is a short but to the point question from the opposite angle to investing for children. At 72, how should I invest £250,000 to £300,000, if at all? Charlotte, interesting question.
Obviously, we're missing some information here in terms of what this person's overall situation might be. But at 72, one thing is clearly time frame. Now, one of the things that always interests me is when people talk about retirement, for example, they often think it's a moment, and then from then on, it's a sort of flat ride. Whereas in fact, even at 72, there's probably a 10 to 15 year time frame that this person is thinking, hopefully, where they might be thinking about what to do with their money. There's also a question of what their goals are. So is this person thinking about this money that will be to help them in older age? Is it actually excess money that they may be thinking about other family members? Do they know they have a health issue where there will be costs to consider as they age further? So it's very much a question of time frame, of goals, of appetite for risk. So again, almost regardless of age or indeed gender, we will have different views on how much risk we want to take. So there is a question of how much we can take, and then just how comfortable are we with the idea of risk. So all of these things should come into play, despite the fact that at 72 that they're asking, the sort of, as you say, the quite binary question of should they or shouldn't they invest. Overall, I would say that it's just worth remembering, as we've been saying, that over a period, equities will tend to pay you more. So if I think about our current projections over the next 5 to 10 years, we would expect equities to be paying a return of ex-US 7.4%. US we think will be a little bit lower because it's been such an outperformer to date, probably just below 7%. If you compare that to bonds, so fixed income, which are lower risk, more likely 4%. And cash, more likely lower again, probably around 3%. So if we go back to that question of how to invest, taking into account time frame, risk appetite, and goals, and remembering that inflation is always there, and as Jeff was explaining, you need to think about your return net of the cost of inflation, then I would say at 72, there's quite a long time to be thinking about how to make your money work a little bit harder for you. And to think quite carefully about what that mix might look like across those different asset classes.
And Jeff, one of the perils, stroke pleasures of the job is being accosted by people who have a question for you just like that. Someone asks you that question, what would you say?
There's a lot of detail that's missing there, Simon, in terms of what else they've got, within, have they got a pension? But what I will say, just kind of in terms of my mailbag, there are now far more people aged in their late 60s and early 70s, throughout their 70s, who are still investing. I think previously, I think maybe 10, 15 years ago, it was very much you came to the age of 65, you took an annuity with your pension, and that was it. But now a lot of people have money in pension funds that they keep investing and keep invested through, through their later years, and then make withdrawals as and when they need them. So I think the case for equities for those people in later life is probably more important now than it has ever been.
I think that's a really interesting point, because I think there's two things on that I would reflect on. One, when someone said to me, one of the most important things, and I think this pulls on a point that you made, Charlotte, is like people need to think about what kind of person they are, and it's not just your attitude to risk if you've done a risk profiling, thing. It's also what kind of person are you? Are you glass half full, glass half empty? If your portfolio drops, how is that going to affect you? Are the kind of person who can be sanguine about it, or are you going to be really panicked? But then also with a sum of money like this, and this is where it comes back to there's not a lot of detail in that question. You can't answer the question without detail. What is this pot of money? Is this a pot of money that you're relying on in retirement for your income? Or do you actually already have that sorted because you've got a final salary pension, or you've got, an annuity, or you've invested your pension, and this is actually just your savings and investments, and actually you've got no intention of ever needing or spending or using that money, and you probably just intend to pass it on as an inheritance, at which point then invest it for growth, kind of thing.
Actually, it makes me think of one thing which I was staggered by. We have a retirement readiness little sort of widget that people can go and have a look at and play with. And one of the really interesting data points that came back is, this is for people who are age 40 and over. Over 50% of people have not thought about whether they are in the right position in terms of retirement as and when it comes. That there has just been a reluctance to confront this question of, am I doing the right things? Am I filling the right pots? Am I putting enough aside? Am I thinking about this carefully enough? And this is my slight worry when we have, going back to the sort of point about cash and these what feel like attractive rates. And I think Jeff was sort of really alluding to this, is the temptation is to sort of do nothing, what feels like doing nothing, lock in something that sounds safe, sounds high, and then forget about it. And actually, it really does behove all of us to think very carefully about making sure we think about investment in the context of who we are, glass half full, glass empty, and so on, and thinking also of those timeframes, because as people's lives extend, the time that money needs to last is obviously growing, and along with that, we have these periods when the markets will feel less friendly. And right now we have a cost of living crisis, which means a lot of people, as we were chatting about earlier, it makes it difficult for consumers more generally. And therefore, everything you can do to try to, in the round, improve on that overall financial situation makes sense. And you want to be doing it for as long a period as you can, rather than having to make a sudden adjustment when it maybe is much later on and it's harder to get to where you want.
Yeah, I think Charlotte's point is a really important one, and the fact is that we are a long time retired, that we are living longer than ever before, and I imagine we will continue to do that going forward. So we need to look after the money that we have as we move maybe from full-time employment through to part-time employment and then full-time retirement. We need to make that money work in our best interests, and that often means risk return, and that means equities. So,
and a lot of the concern about it comes from people who are they're not approaching retirement as in it's immediate. They're approaching retirement, they may be 5 years off or 7 years off or something, and it's picturing how that looks as well. And I think some of the work that, for example, the Pension and Lifetime Savings Association have done with the basic, the moderate, the comfortable retirement, that gives people a picture of what it might look like. But I guess one of the important things for people to think about also is, will I continue to work a bit? Like you just said, it's if you're in the position where you have the skills, the expertise, the desire to do a day or so's work a week, that makes a big difference, doesn't it?
I'm going to be a postman when I leave journalism, Simon. So I'm not going to go. It's not going to be a cliff edge, and I don't think it is for many people. I think they'll find jobs in supermarkets, for example, just something on a part-time basis. And that is something that has changed from 10, 20 years ago when, you took your final salary-based pension at age 65 and that was it. You put your slippers on and you relied upon that monthly pension to see you through until the glorious end.
Sorry, I was going to say, you mentioned something very interesting there, which is our inability as humans to really be able to envisage what does something mean if it's 20 years away, 30 years away. So I think that is one of the problems that we found in terms of people saving for the long term, because retirement seems like such a sort of far away mission. And this is actually where I think technology becomes very important. One of the things that we find is if you have something that helps you visualize, what do we mean by you put in this amount today, it grows by that amount over the next 10, 20, 30 years, what do you arrive at? And what does that let you do? And is it what you expected? Or in fact, were you thinking it would be more than that or less than that? And I think this is something which sort of modern day wealth management should really help the financial consumer with. Because if we can start to recognize what we can do to help that future point, and we can see what that future point might consist of, we're much more likely to have the general community engage with their money and do the right things during that course of careers and then stepping into maybe semi careers and then ultimately into full-time retirement.
Okay, back to one of the reader questions now. Actually, I'm got it here. I'm heavily exposed to property as an investment. Should I break away from this and diversify across an investment portfolio that includes pensions and ISAs? Buy-to-let has been a hugely popular investment in this country. People do like to think of their property as their pension, but it's looking a lot less attractive now due to various tax changes and people potentially just looking at the hassle of it. Is this something that you encounter quite a bit with clients? And what would you say to someone in this position who's thinking, right, I think I'd want to take a step back from this buy-to-let game?
Yes, I think it's something not only we see a lot of, but I like the fact people are asking the question now. Because when I talked about the easy money scenario that we've had for, call it 10, almost 20 years, that's been a period during which it's been cheap to borrow and house prices have gone up. And you've had the tax break. So one way or another, there's been quite a lot of reasons why buy-to-let might have felt like a good alternative to a pension if this is how this person's been thinking about it. What we know now is, one, the tax breaks are much less exciting. The outlook for property prices less exciting. And given what's going on in the current environment, just managing a portfolio when people aren't paying the rent and aren't going out and getting out when you ask them to, or just the hassle of actually managing that has risen. The other thing about property is, of course, it's illiquid, meaning you can't actually tell what it's worth today for sure. And if you suddenly need more cash, unlike with a pension or with a savings account where you can draw down and give yourself extra cash flow if that's what's needed, actually to go out and sell a property, go through all of that, pay the taxes that involves and so on, is a time-consuming and quite expensive business. So I think the right thing probably is to have a mixture. I mean, we're big believers in diversification within an investment portfolio anyway, and I would say the vast majority of clients, property is part of that diversification, always starting with their own home. And then sometimes, if they're lucky enough, they might have some buy-to-lets, but it shouldn't be as a complete alternative to the financial markets.
Jeff, my property is my pension. I bet you wish you'd had £1 for every time you'd heard that line. Charlotte touched on a point there. There are buy-to-let. It's been hugely popular, hasn't it? But the mortgage rates and tax relief are not in people's favour at the moment, and often people with buy-to-lets tend to be very exposed to that buy-to-let, don't they?
Yes, I've been a fan of buy-to-let, and it's been a positive force really in society, hasn't it? It's given a lot of young people the opportunity to rent, so it's fantastic. But there's no doubt that the landscape has changed, and it is essentially because of the tax regime that the government has hit landlords seriously hard with a whole series of draconian tax changes. So I'm very much in the Charlotte camp here that, yes, have a buy-to-let property, but it should not be the thing that you are depending upon in terms of your future investments. I mean, I think really diversification has to be the order of the day. You can argue whether the government changes to the taxation of buy-to-let is wrong or right. I think it's wrong. I think it's seen amateur landlords in general as an easy way to raise tax revenues, and it is wrong, but it has literally strangled the market, and I can't see it making a renaissance. So I would say to anyone who's thinking about becoming a buy-to-let landlord, really do your homework, because it is fraught with danger.
And actually, this is a good point. For all the bashing that buy-to-let gets, there are a lot of really good individual landlords out there who look after their tenants, look after their properties, and do a good job. And ultimately, people need places to rent, and the rents going through the roof at the moment is largely down to a shortage of places to rent. But it's definitely not a tax-friendly place
I mean,
anymore.
landlords have, I don't know, they've almost kind of been victimised. I mean, they're seen as the bad people. I've never really understood that. They add to the goodness of society. They are providing people with the ability to rent before ultimately buying maybe their first property.
Charlotte, we had a question earlier that was pretty to the point, didn't include too much information. We have the opposite here, one that is much more specific. My pension matures in 18 months' time when I get to 60. I know about my options regarding taking 25% cash, drawdown, annuities. My deliberation is where to put my pot once it matures. It should be around £330,000. I want low-cost management charges, but equally I want a fund that makes a return, especially if I don't want to touch it for 3 or 4 years while I continue to work for a while longer, though probably on a part-time basis, something we discussed a minute ago. My other option might be to continue paying into the pension with smaller contributions so I can continue getting tax relief. Without straying into the realms of financial advice here, which, just to be clear to anybody watching, none of this is financial advice. What are your thoughts on that question?
Well, one of my thoughts is they're only 58. So there is quite a long time for this person to be thinking about their financial planning, and they're obviously quite well up to speed in terms of their options. They're talking about continuing to work and continuing to add to their pension, which to me sounds like a very smart idea, that if you can, you should. And I think there was an interesting point that they asked, which is that they want something low cost and they want something that has high returns. Somehow the implication being the higher the cost, the better the return, possibly. And that is something which I obviously have very strong feelings about, and was one of the reasons I started Netwealth, because what we see over and over again with retirement pots, and this is partly because people often have several careers, and so they have them sort of pension pots spread around, and they might have lost track of some of them, or they simply haven't engaged with them, that quite often people are paying significantly more than they realize and significantly over the odds. So in this person's case, he's, let's say, coming up to 60. So he might have 30 years during which time this money can work for him. And for somebody who is paying 1% every year in excess fees, the impact of that is 14% of your capital every 10 years. So if you take 100,000, that's £14,000 you're paying to somebody else rather than keeping for yourself. And we've just said you can multiply that by 3 for him in the case of a 30-year retirement. So he's absolutely right to be asking the question. It could be that he wants to manage his retirement funds himself, in which case there are DIY platforms when you can do that, and you should expect you can do that at a relatively low cost. Otherwise, if you want someone else to manage it for you, which is the option that most people will take, because for many people it's not what they want to do kind of on a very regular basis, managing their own money, then just make absolute certain you understand what the all-in costs are that you'll be charged. Because over that long period during which those funds are meant to be working for you and building up for that period when you're no longer in work, it can make a colossal difference to that outcome.
Jeff, you've spent a long time campaigning on investment fees. Investment fees have come down over that time. I'm not sure we can entirely credit you, but I'm going to here. It's all thanks to Jeff Prestridge. But they're still
not quite.
They're still not as low as they could be, and people need to watch out, don't they?
They do. I think, as Charlotte says, you need to do your homework. You need to understand what you're signing up to. In this particular person's case, I mean, I think the overwhelming message to that person is to keep investing. Keep investing in the pension, even if it is just a little every month on a regular basis, because as Charlotte has said, they are only the fragile age, the youthful age of 58. So, pensions are a super way of investing. You get tax relief on the contributions that you make. The more the more you put in, the more ultimately, hopefully with shrewd investment management, the more you'll get out for those years when you will be drawing upon it to help you through later life. So absolutely, what is essential here is that the pension vehicle that they're using is consumer investor friendly. And not every pension fund is ultimately investor friendly.
And it's a question also that taps into something that's become very much more of a thing. The not early retirement in the old sense of early retirement of, great, my company pension matures when I'm 55, I can hit the golf course. It's early retirement in I'm not actually going to retire, but I want to work on my own terms. I want to do a couple of days a week, and I've got this pot that I think can see me through. I'm going to try to rely on the money that I can earn. But people need to think as well, don't they, that they're not going to get their state pension until a considerable amount of time after that. And that does represent a sizable sum of money for people that they're going to need to cover in those intermediate years, doesn't it?
I think it comes back to this point I was making about knowing what you've actually got. We did some really interesting data work on just the degree to which people have lost their pensions. On average, people have lost £28,000 of pension value among those we surveyed, which was over 2,500 people, which seems extraordinary, really, that you could lose it. But I think one of the problems is that the way typically financial service people provide information is not easy to understand. It's not that accessible. We talked before about sort of technology being lacking. And all of those are reasons to try to aggregate what you've got, understand what you have, and make sure that you're getting it to sort of do the most it can do for you in order, as you say, to sort of fill that gap that might exist between now and drawing down a state pension. And I think actually one of the things we see a lot is it's not easy for people sometimes if they decide to make the switch. And that's another massive problem for UK financial consumers. And Jeff, you may have seen this as well. So what we've found is that sometimes when people want to switch, it's made very tricky. You know, they have to answer questionnaires, they have to fill in forms. Suddenly the forms are lost when they send them back to the provider they're trying to move from. And it's an arduous, time-consuming task. So one of the things we've tried to do to help that is do as much of the heavy lifting as we can, because it must be wrong for people to sort of do the homework that we were talking about, to get themselves in a better position, and then find it so difficult to switch that they sort of just in the end capitulate and just leave it where it is. So I think there's still too much of that, and the regulator has been quite active in terms of both fees and trying to help people. Same with your current account, being able to switch that more easily. The same with pensions, people should be able to switch. Of course, recognizing security and the potential for fraud and so on, that has to be part of the assessment as whether or not this person really is the person they say they are and they really do want to switch. But on the basis that in most cases that is what people might want to do and they are the person they claim to be, I think it's all part of trying to grease the wheel better for financial consumers, to let them really make the most of all those years they've been working, all that money that they've saved, to then have it work for them.
And Jeff, I mean, I guess there's actually some people out there who think they've just lost their pension altogether. Yeah. And also there's some people who then find old pensions, but if you do find an old pension, you need to go through it carefully, don't you? Because there might be some stuff in there that's actually quite good. Yep. This crops up quite often, doesn't it?
Yes, exactly. I mean, some old style pensions maybe have a right to something called a guaranteed annuity rate, which can be an extraordinary amount, 8, 9, 10%. But I mean, I think it's so important that people really try and keep on top of the pensions that they've built up through their working lives, because we often forget that maybe we worked for an employer for a couple of years and built up a small pension in period, but have then kind of almost lost track of it. And as Charlotte has already said, and I think this is a very good point, it really does pay to have a look at what you've accumulated, the various pots that you've accumulated. As you've just said, Simon, look at maybe the merits of keeping some of them because they have special features that are in your financial favour. But in many instances, it will pay to consolidate some of those pension plans into one pot where the charges are very much in your favour and not in the favour of the insurance company or investment company operating behind the scenes. So, and Charlotte's given us the figures about the amounts of money that you can save by having your pension fund under the wing of a company that gives you value for money.
Thank you. Another question from a reader. Charlotte, I'll come to you on this one. I'm a self-employed mum in my mid-40s and try to save each month into a pension or pay in a lump sum each year. I save any extra money I have in cash. I'd like to invest to get a better return, but I'm worried about losing money and also don't have the time to spend hours picking and monitoring investments. What would you recommend I do?
Well,
without the answer just being come to Netwealth.
I'll try to restrain myself from saying that. Although I think it's very interesting in terms of the question coming from a woman and where she's doing the right thing by paying into her pension, and then she's saying extra savings she's leaving in cash. Now, as we've said, possibly being in cash right now is not a bad thing, but it certainly has not been a good thing in the past, given how low cash rates have been. And one of the things that we do tend to find is that female investors are more cautious and, in fact, often don't invest. They save. And the reason they save is because they have very clear goals and things that they're trying to achieve for their children, for their parents, for themselves. And they're anxious, as she has just described, about taking risk with that money without realizing that they are taking risk with that money by not investing it. So I would say in answer to her question, she is also recognizing the fact she doesn't want to manage the money herself. So she should be thinking about finding a group that can manage on her behalf. It sounds as though she has excess money she could put into the investment markets rather than leaving in cash. And I'm going to assume, given she's described herself as a mum, that her children are still relatively young, and therefore she is likely also still to have a long time term frame, although we'll also be thinking about those children, and potentially that money is, for example, to help pay them through uni, or to help them, in their sort of late post-school years. So she's asking all the right questions. I've been actually interested, just to come back to Netwealth, to see that almost half our clients are women. In the traditional wealth management world, it's roughly 25% female clients. And so as a broader comment, what bothers me is that not enough women are investing. And so again, I think technology can be helpful to just help somebody visualize what they're trying to do. Often women work with goals that they have, as we were talking about, and they're also classic sort of multitaskers. So to the extent they can visualize what they're doing with their money, why they're doing it, line it up against those goals, tick that box, now I'll go and do my next thing on my list, can be very, very helpful. So she's asking all the right questions, and I certainly think that she should be thinking very carefully about the risk she takes through not investing.
Jeff, male or female investor, what there is with savers and investors is there's a lot of inertia, isn't there? There's a lot of, I know I should do this, and I think I should do this. Oh, I never get around to it. I'll just put it into cash. How important is it for people, when we go back to that importance of long-term investing, to just try to at least make their life easy and get over the hump and get started?
I think it's key. I mean, we need to get over that hump as early as we can, because the earlier we start investing, the greater the opportunity we give for the fund that we're building up to increase in value. And, I'm a big believer in regular investing, Simon, whether it's through a pension or whether it's through an ISA, or whether it's just through a straightforward investment account. You know, a lot of the time, I think makes far more sense than maybe putting money aside on an irregular basis. Investing is not without risk, and obviously that's something which, you know, people have to take into consideration. But if their time horizons are long ones, then I think the case for equity investing is very compelling. So to me, the earlier you can start, the better. And don't be embarrassed if you can only put £10 or £25 away every month. You're building up a financial fortress for the future.
And the younger you are, the better. I mean, the figures in terms of if you work out, you know, £50 a month over 30 years versus £50 a month over 40 years, you, at the end of it, on a steady rate of return, you double your money. So it's well worth starting early. And the point you made there nicely segues us into our final question, actually, which is, I keep hearing talk of a potential significant stock market correction, and I'm worried that shares are overvalued. Do you think such a correction is likely? And if so, would you still invest in the stock market after over a 5-year horizon? Charlotte, what's your thoughts on that?
Okay, well, I'm going to hark back to something that Jeff talked about right at the beginning, which was the 1987 Wall Street crash, because I had just been hired by JP Morgan and there was a crash. And my job, just like yours, was very much at risk.
Am I sitting in a studio with the two people responsible for the 1987 crash?
Certainly not. But what it has made me think about is you start your career with a major crash. And then, of course, there have been a series of difficult market environments, most recently with the pandemic, and then even more recently with Ukraine and the Russian invasion. And market volatility is par for the course. And what we often see is really very soon after those significant down moves, you see a significant up move. And there's a point at which the market, as in the professional investors, say, enough's enough, I'm now a buyer. And trying to time those moments is impossible and a fool's errand. So it goes back to really what we've been talking about before, that if your time frame is long enough, you should invest. You shouldn't be worrying about day-to-day movements. You should expect volatility, live through it, and expect that you will have a net positive return at the end. So my answer to that question, which was, I think, with a 5-year plus horizon, would be that I would invest. All else being equal, I would invest. And the one thing I would think about if I was concerned about market volatility in the very short term is I would potentially stagger in my investment. So I would average in as opposed to put it all in, say, from cash to the market today.
And that drip feeding in goes back to your regular investing point, doesn't it?
Yep,
Jeff?
I'm passionate about regular investing. It doesn't decimate your pay packet. It's money that you almost forget about, but it's being put to good use. You know, there are loads of investment professionals across the world. They never agree. You know, the one person says there's going to be a market correction in the United States. The other one says, you know, equities will keep rising. So it's impossible to second guess the stock market. There are very few gurus who have long-term reputations for guessing when markets are going to fall and when they're going to go into a bull market phase. So on that basis, I think it's better to be a steady Eddie or a steady Janet. Keep investing for the long term. Don't get upset when markets fall. As Charlotte has said, that is part of the stock market. You have to accept it. But ultimately, if you're patient, you will be rewarded and you will smile for that patience that you have shown.
I always think it's interesting when you interview fund managers how many of them basically say don't try to time the market, when if they were going to be entirely honest, part of their job is actually trying to do that. But even they, as very, very well-paid professionals, say, don't try to do this.
Yeah, absolutely. I mean, I interview a lot of fund managers, Simon, and I love it when the market corrects, because they always say, well, great opportunity now to buy. You know, I always laugh at that. But, you know, my view is just keep investing, try to cut through the market volatility. Markets do tend to drift upwards over the long term. And if, you know, it's about patience, it's about not losing your cool. I mean, I met a gorgeous reader the other week while I was out walking, and he said, you know, we'd got talking about money. He didn't know that I was a journalist to begin with. And he was saying about the fact that he looked at his investment portfolio every day. And I said, if you're going to keep doing that, my friend, you will soon have a heart attack. Take a step back. Don't kind of take micro control of it. Be patient. It will continue to grow in value.
And there's that temptation, isn't there, when something happens for investors who do look at their portfolio every day to try to act, but they are obviously acting after the moment, aren't they, Charlotte?
Yeah, I think market timing, as we were saying, is impossible. And actually, just going back to this question of really active fund management and people who are paid to outperform their benchmark versus investing in passive funds, which has become much more popular over the last sort of 5-10 years, is quite an important aspect to trying to take into account the overall cost of investing. So passive funds aim to track an index. And if you have a diversified portfolio where you're accessing the key different markets around the world across fixed income and equities, then you can actually access that market at relatively very low cost, where there's no timing involved. You're just long the market and you will earn those returns with the smallest slither of fees. And actually, the reason it always makes me smile when people talk about active versus passive is because what we've now seen over a period is that long-term track records of active managers have demonstrated very clearly, to Jeff's point, that it's very, very difficult to outperform the market. And it's partly because of the amount of information there is available now, and it's a very different time than it was perhaps 2-3 decades previously when the markets operated in a different way. So I think just patience, simplicity, transparency and liquidity, and that will sort of see you through.
And value for money.
And value for money.
Well, that is all we've got time for. Thank you very much, Charlotte. Thank you very much, Jeff.
Thank you.
And thank you very much for watching. It's been a pleasure. Join us next time. Goodbye.